Thanks for joining us here on the Retirement Income Source, where it's always going to be about investing for income the old-fashioned way. I'm Tim Sparks. Our show is sponsored by Sparks Financial Group, a financial firm right here in the heart of Bluegrass, Lexington, Kentucky, and also serving Central Kentucky. This show is for you, the listener. What I teach here on the show is based on my 20-year experience on what to do and, most importantly, what not to do. See, whether you're a pre-retiree who wants to get it right or a retiree who's already in retirement who wants it to end well, you want to pay attention to this show because we do have some strategies. I'm not trying to say this is a silver bullet, but I do know it works. And it's different. And they always say different is always better, but better is being different. But when it comes to your money, you should be diligent. You shouldn't get in the back of a taxi cab and just let your financial advisor, and this is nothing wrong with financial advisor, maybe doing a good enough job you don't even need. You can just let it go. But I have found too many people come in here and learn by experience over 20 years by letting go of the steering wheel in that taxi cab analogy has basically hurt them more than it's helped them. Because that, if you think about it for a moment, when it comes to retirement, and it's really dealing with your money, your livelihood, the goals you're trying to meet, and whatever it may be, at the end of the day, you want to make sure that your money is working for you as hard as it needs to be working for you, because there's so many things, so many challenges that your money is going to go through. Today, we're going to be talking about live and learn. I'm sure all of you have said that one time or another. And I'm going to digress here for a moment. We're having some issues in the home front, and it's a lot of it just my wife is going through some medical issues right now, and it's to the point where we just don't know exactly how this is going to end up. I just know that she's been there by my side for all these years, and she's just she's still young and stuff, and she's really been challenged with a major health issue that could involve cancer, and we're just hoping that this coming week that will go away. Hopefully they fix the problem. They don't necessarily know, not until Tuesday. I won't be in the office on Tuesday, spending time in the hospital. But at the end of the day, you never know what's going to happen and when it's going to happen. And when it does, it changes your perspective very quickly. And kind of reminds me of a client also who had contacted me 2 months ago, who lost her spouse, lost his wife in the middle of the night, in the bed. I couldn't imagine what that would even feel like if, here you are asleep, you wake up next morning, a person, you've loved and been with for 40 plus years has all of a sudden passed away. They're in the bed right beside you. So, we just don't know. And that, and I bring that up. And some of the reason I bring that up is, we talk about estate planning, and I'm just going to talk about just briefly here before I get into the heart of the show, live and learn, and start talking about some things that I have learned over the years and that I continue to improve, continue to tweak to make things better. But estate planning is something that I think people needs to get informed on. And because, as I have talked about in prior couple shows, over the last 6 or 8 weeks, I've already did at least 2 of these shows, and they're on our website. I went into them more in depth, but and I'm running across it again right now, just here recently with current clients and so forth. Of the things that are going on, even in the estate planning market, and especially with even the legal representation of the people they're working with, telling them not to fund the trust and so forth. And then I talked to an attorney, a part of the group that we work with, and I said, why is that? Because you guys focus on getting the trust funded and getting them, all the assets and everything assigned, and then others tell me differently with their attorneys, and, it puts people in a quandary. They don't know what to do. And, at the end of the day, people, don't do it. And I'll tell you right now, what's going to be the effect of that right there is exactly what's happened with several clients of ours over the years who didn't really do proper estate planning. And what happened, their heirs, the children and stuff that they love, wind up having a lot of financial distress. And I'm sure they didn't want that to happen, but it did happen because they went, they were listening too much to and put too much weight into the legal advice. And it's a shame, but that's our industry. People don't realize if you don't do proper estate planning, and it doesn't matter if you have a will, like I say, a will guarantees probate, and so does a non-will. And probate has its positives. It wants to make sure there's no debts or anything that are obligated to that person that passes. But at the same time, you could as easily done that with a trust and didn't have to go through all that. And if you do it correctly. And so I'm a big fan. If you start something, finish it, get it completed, quit playing games with this kind of stuff. And when it comes to estate planning, people put this stuff off and think it's just, it's just, I'll wait till the time comes and crunch time and then I'll deal with it. And I do see that a lot too. Procrastination is the number one enemy today. And I will tell you this much, procrastination will never, ever avoid probate. You know what avoids probate? Action does. You have to take the right action. So basically, I just told several couples who actually called in on the radio show and told them you need to get a second opinion. And then also, I gave them some questions to ask just because I've seen it by experience that I've seen other people who didn't put their homes and stuff pointed or to the trust and stuff. And I get why, some reason why they're, the recommendations don't put it in there, if you ever do a mortgage refinance or something like that. But people, there is certain ways that you can actually set that up and have your cake and eat it too. Don't leave stuff like that to chance, because at the end of the day, when you pass, there is going to be an expense that somebody's going to pay, and it's an unnecessary expense. And it can be fairly lofty if you don't actually make some decisions right away, because we don't know. Elvis Presley didn't know he was going to die in the bathroom. Neither did Prince, the famous pop singer, think he knew he was going to die in the elevator. At the end of the day, we just don't know. None of us are guaranteed tomorrow. So if you want to know more about that, and again, I promise I'm not going to talk too much. I just wanted to digress a little bit just because of what's happening with my wife and some recent clients, that you don't want to put this stuff off, and including myself. We didn't put it off. And so we've already got everything buttoned up, but there's still some things that we need to clear up. And thank goodness we have a digital trust where we can actually go make those changes. And if you want to have 100% control, there's only one way to do that. And you can call in our show, 888-930-1080, and schedule an appointment with myself. I'm not an attorney. I don't do that for the sake of disclosure. But then again, we educate the public up to my limitations as a financial advisor, and then we pass the baton to the people that knows how to get this thing done for you. It's the research I've already done and the work I've already done, because I don't like the way the advice is given today. So hopefully, even if you're an attorney out there and you're in this industry, you need to get this done correctly, or make the suggestion and put the onus on your client's back about getting these trusts funded, because that's where I see the biggest mistake. And I have talked to attorneys that tell me the range of between 85 to 95% will not tell their clients to fund the trust, because for some reasons, and so we put too much weight into that, and we're just presumptuous assuming that that we're going to avoid probate. I'm going to be honest with you. Why even do probate, or excuse me, why even do a trust if your whole purpose of it is to avoid probate, but yet we're setting people up to go through probate. And so just do your homework. I mean, I'm telling you based on my experience, what I've done, what I've seen, and I'll tell you the people that actually take action are the people that's already been through it. And it's usually typically people of executors of wills, or they're already trustees of the current trust. And they'll tell you the aggravation it is to go through and have to facilitate all this on behalf of the beneficiaries. It's not easy. It's not an easy task. But whenever you bring up something or about, doing estate planning educational classes like we do here in Sullivan and Lexington, Kentucky, and so forth, we bring those. When we start talking about this and these people show up, they're immediately going to come in. Why? Because they understand it. What I have found is people don't understand it is because, and the reason why they procrastinate and don't do anything is because, well, they just don't know if it's for them, because we don't think of it that way until we should be thinking about it in a different perspective, because at the end of the day, it will come as an expense. And there's a lot of problems on the back end. You should ask your attorney what that would be. Probate costs are going to occur. If you have no plans whatsoever, if you just do the least that you can get by with, then you're still going to have the same problem. If you have a will, then you're still going to have to still deal with it. Assets may go where they want to go, but at the end of the day, it's going to come at a cost. Probate, again, is a cost. Look it up. In the state of Kentucky, it could be up to 5%. If there's kids or anybody involved, disinheritance involved, or other people that maybe you've been associated involved, anybody can come and make claims on that for up to 6 months, and then your assets and everything also freeze. There's a lot to this, but we're going to get on with the show here, Live and Learn, and talk more about financials going forward. But I just wanted to, again, talk a little bit more about that going forward. So if you would like to learn more about income first methods, which is what we're going to be talking about today, not necessarily, of course, the show is about income. If you want to know more about income first methods and why I have learned, the topic of the show, Live and Learn, why income first methods actually assist your growth. Why? Because you're spending it from real income. You're not taking it from your actual principal and hoping to grow it back. And if you want to know better defensive income strategies, then my book is available, The Retirement Income Shift, How to Get the Most Mileage Out of Your Money. And it's Amazon's bestseller, has been for the last 3 months in about 4 different categories, at one time up to 6 categories of personal finance. And it could be yours if you're one of the first 5 callers on today's retirement income source, 888-930-1080. Again, that's 888-930-1080, and we'll mail it out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks. I'll be right back. Welcome to the Retirement Income Source. This is Tim Sparks. Our show is sponsored by Sparks Financial Group, right here in the heart of the Bluegrass selection, Kentucky, and also serving central and northern Kentucky. Today, we're going to be talking about Live and Learn. I've learned that investing for income promotes and allows growth because I'm not selling shares to get income. Here's what I'm going to tell most of you that are actually listening. The typical retirement plan today is an withdrawal retirement plan. You can put your whole 401k into the bank CD and keep it safe. And if you're earning 5% your first year because rates are up, you got fortunate enough, rates are finally up in CDs, then that's income. You'll get 5% the first year. You may even, let's just say rates are slowly, progressively going to come down, which they will. Let's just say they drop to 3. You'll get 3% the following year. But somewhere, as we already know, CD rates doesn't last forever. They're eventually going to come down. And when they come down, I'm using it. I'm trying to make a point right here. Eventually they're going to come down. Yes, you're safe, but on the average, CDs typically average a little over 1%. And especially in the last 20 years, they haven't hardly done anything. And even though you're safe, you know your money's going to be there. You're going to be basically going broke safely. Why? Because you're going to have to spend your principal. You're going to watch your principal go down. There's no way around it. You may, methodically take money out as you need it. But to me, that's what I call an average retirement spending lifestyle. I wouldn't even do that. I wouldn't even step into retirement if I was going to have to do that, because one thing I do know, most people that settle for that type of retirement plan typically are spending much less than what they did when they worked. If that's what you want to do, that's totally up to you. I'm not saying there's anything wrong with that, but so many people leave money on the table because they don't totally actually understand how to invest for income the correct way when they go into retirement. So therefore, they just settle for what seems to be more easier to them and things that they most know about and most comfortable about, versus going out on the limb and trying to learn about other strategies out there that can actually help them to possibly even still accumulate wealth while simultaneously taking out income. You do that, and this is the live and learn part, you do that by investing with stocks that pay income. Now imagine that. You can do that with an S&P 500 index fund. The problem is getting $15,000 out a year, and I'm using $1 million scenario right here. $15,000 a year is probably not going to cut it when you saved $1 million, right? But if you did, the good news is you're just spending the dividend. You can do that in that fund. Hopefully you're not paying a financial advisor to put you in that type of fund, because you can do that on your own. That's so easy. A caveman can do that type of strategy. You can go to Vanguard and get that kind of strategy. So typically that type of fund is not really there to generate income. And if it does, that's all you're going to get. And if you say, well, I'm going to take out $40,000, well, I hate to tell you, you're going to sell about $25,000 of that each and every year. And unfortunately, you're going to do it monthly, because most people want their income monthly. And it's really just going to come back to you, your own money. Think about that. Who wants their own money paid back to them? If you want to take your own money out, you do that when you're about 15 to 20 years down into retirement. But why? Because when do you need the money the most? Well, inflation hedge, you need to prolong it and get the most mileage that way. Also, you need it for other expenses that are going to actually go up, not just inflation, but also rising healthcare. Because as I mentioned earlier, we have just an average insurance plan, health insurance plan, and I'm going to be out a pretty good chunk of change here for my wife to go into to do surgery. But that's, again, it's an expense. And if you go through it, yeah, if you got Medicare and all that, it helps pay and offset some of that. But there's still expenses that come out. I mean, I can tell you of clients that have that we're dealing with right now, that the type of prescription drugs that they're taking that makes them feel better, their Part D doesn't even cover. So they're having to take out more money because of that. These are some of the gotchas that people don't think about later on in life. And so if you're spending your principal, you may not even be able to take advantage of some of those. You may have to have a lesser of a prescription that may feel uncomfortable about, when you can maybe, get a better prescription and feel a lot better. But at the end of the day, you get to the point, you want to be able to preserve your principal. You preserve your principal for what's most important. Even home health care. Home health care today costs, most people self-insure when they go into retirement. If you self-insure when you go into retirement, that means, home health care is going to cost quite a bit. If you want to have a nurse to come in your own home, we're dealing with that right now with several people that are going to have to take out anywhere between $8,000 to $12,000 a month. That's a month, not a year, out of their portfolio just to pay for that nursing home to come in their home. And that's today's cost. What do you think tomorrow's costs are going to be? We don't even think about that. That's the reason why, again, you want an inflation hedge, you preserve your principal, and you do that by living on income first. So that means you got to get your income up and sort of to the point. And the only way you're going to do that is you got to have income tools that provide you income first, so that way you can get income and growth. And we're going to be talking a little bit more about income growth tools and how they actually typically have outperformed the market. And these are real numbers, not hypothetical numbers, that some stuff we ran on, fun for fun in the last 25 years. And we're going to talk a little bit more about that. And this is another one of those live and learns that I want to share with you today. So if this makes sense to you, in other words, if you want to have income first methods, first of all, what income does is it creates defense for your stocks. That's what a dividend does. Stocks go up in value over time, but if you're spending your shares, you're not going up in value over time. Think about it for a moment. You're eliminating your ownership, which means just over time, you're going to hope and pray you have more shares and you do have income, because at the end of the day, you're going to run out and you don't want to do that. So there's a commission report to get in your hand called The Importance of Financial Defense. And this report can be yours if you call 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to you or email it, whichever you prefer. Again, that's 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks, and today we're talking about live and learn. Well, I've been doing this 20 years, and I wish I could go all the way back from the day I started. Because when I get into something, get into anything, doing anything, this was back whenever I had other careers. I've had a couple careers, and I switched over here. This is where I like being. This is me. This is who I am. But it took me 2 or 3 years to do a lot of learning. I'm a self-taught person, very self-direct. I spent a lot of time learning. And also experiences, good and bad, also teaches us as well, right? But at the end of the day, I want to learn about taxes, how it affects retirement. I also want to learn about estate planning. I want to know about retirement, what is good retirement plan, sound retirement planning. And I did that. And the live and learn that I learned from over the years, for you might as well say first 14 years of my career, with the exception of the last 6, have been focusing on doing things like Monte Carlo analysis, showing people that the markets will always come back, showing them how using portfolio software tools, and displaying it on a big old screen television in our office, making the office look plush. The people come in, they get that financial feel, and at the end of the day, I didn't feel comfortable because I knew that the results of what I was recommending wasn't going to be there. Why? Because at the end of the day, I knew that I was helping people sell their own principal, giving it back to them. And actually, about every time they took out $10, and I'm dumbing this down, 7 of it came from their own money. The other 3 was coming from real income. Now I have learned that I want all $10 to come from real income and nothing to come out of their principal. To me, it just makes perfect sense. I'm just a common sense guy, very logical guy, and it doesn't take a rocket mental heavyweight to figure that out, because it's easier to just live on the eggs and never eat the chickens. But the advice today is forcing people to actually kill their chickens slowly but surely, and minimizing and running out of eggs before they run out of breath. And, think about it, that don't even make sense. So, but the retirement plans today are built on, you better have a ton of chickens in that barnyard. And I'm using your portfolio in this analogy because eventually you're going to run out of eggs. You're going to run out of income And, at the end of the day, it's the advice that's been given. That's what I've learned over those first 14 years. Now I'm learning that, hey, wait a minute, here, I totally was given the wrong advice. And so now I've learned that, at the end of the day, it's the advice that's been given. That's what I've learned over those first 14 years. Now I'm learning that, hey, wait a minute here, I totally was given the wrong advice. And so now I've learned that why not get the eggs up to where there's so many coming in that now the client has a problem spending the money, the income they're getting, we biggie size their income, and that was a much better proposition. So if you want to know more about these income first methods that allows you to have growth, you do that by having your farm. You keep the farm, don't sell the acres, which is what you're doing right now. I hate to tell you that, it'd be the very bad news, and just live off what the crop, the income will generate. You will have your cake and eat it too. If you want to learn how to do that, I got a book, my book, Retirement Income Shift. And this book was Amazon bestseller, personal finance, for the last 3 months, I should say. It just came out, new release in October. And you can have this book if you call 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks. We'll be right back. Welcome to the Retirement Income Source. This is Tim Sparks, your host, and this show is sponsored by Sparks Financial Group, a firm right here in the heart of the Bluegrass, Lexington, Kentucky. Our firm also serves both Louisville and Northern Kentucky, Central Kentucky markets. And today we're talking about living and learning. I'm sure most of you have actually learned a lot over the years of what not to do, and most importantly, what to do, and most importantly, what not to do. I know I've learned. When it comes to investing for income first, and that's exactly what we suggest, it allows you to be able to keep your shares continuing to go up in value. Why? Because income is paid on a per share basis. You sell a share, you just got rid of a little bit of income in your portfolio. What I have found when you're dealing with mutual funds and ETFs, the income is minuscule compared to owning individual companies instead. And I did say minuscule. In other words, for every time you get $1 in income, our clients are getting $5. That's a huge difference. That's what I mean by biggie size versus staying where you're at. Think about it. You're trying to get the most mileage out of your money, and you're doing it totally the wrong way. You see, what I have found watching successful retirees is they don't pay too much attention to the noise, in the markets and stuff, because each and every day the markets are going to do something, right? Especially when it comes to your statement balance. They're going to fluctuate. You can't control that. What you can control is how you invest for income, because you need something residually coming in that's more reliable. You see, they stick with the plan. They don't want to switch lanes. Switching lanes is exactly what people do after they have been a year or 2 years into a retirement plan. They think that the grass is greener on the other side as they start seeing something performing better than others. Also, the opposite is true when things get worse. We want to switch lanes. That's even worse. Well, if you have a strategy that allows you to stick with it, the only way you can stick with a strategy and let the markets do what the market's going to do, you can't control them. Don't try to market time. Just have the right companies. Or have the right stocks, have the right bonds. That means you have to understand and be a student of how dividend-paying stocks work. Most people don't have individual stock dividends in their portfolio. I know that because I see portfolios every day. They're consistent of mutual funds and exchange-traded funds. If you're going to stick with that plan, fire your advisor. You're just paying too much money for something that you can do on your own. I've learned that the first 14 years since I've been in the business. At the end of the day, as someone once said, if you're on the wrong train, be sure to get off at the first stop. The longer you stay on, the more expensive the return trip is going to cost you. I picked that up on LinkedIn the other day, and I said, well, I think I may use that on the show because it's so true. This show, we talk about the successful formula for retirement. This formula didn't matter when you were accumulating assets. You were setting money aside. You were doing the right thing. It was the money you were setting aside that had all the difference in accumulating wealth. And not only that, it was out of sight, out of mind. You just knew to set it aside. And then 30, 40 years later, you had this big account that accumulate called a 401k. And it was what made those returns was, believe it or not, this same formula. The total return equals ING. You combine the two. Income is interest and dividends. I'm hoping you were in stocks during that time. Dividends plus the growth. You were getting two things for the price of one. But when you go into retirement, you want to switch gears. You want the I to be the most important part. Why? Because you got a problem. You need income. And if you want to solve it, what better place to solve it than to get on the I side of that equation? Because you can't solve it base everything on the growth part of the equation, because growth comes in clumps. There's times it doesn't occur at all. Sometimes it even occurs at a loss. And you have to deal with the loss as much as you deal with the gain. We talk to people right now, they're concerned about the tariffs, what they may do. Is it going to cause inflation? Well, one side of the media says it's going to cause inflation. The other side it says it doesn't. Well, let me let you in on a little hint of some stuff that I actually studied. And you can go back and do this. I'm a history buff, not to the extent of some other people. But did you know prior to 1913, there was no taxes in the United States? Prior to that, there was tariffs, and tariffs was assessed to other countries. We used to actually balance our credit card. I call our national deficit. There's been many times we didn't owe anything to anybody, and now we do. So I don't know if that's where Trump is going with this, tariffs, but he has brought it up a few times. And we do know this is the year that taxes are going to change. Why? Because they sunset. The income tax rules that we've been following has been around since 2017, and they were made to sunset this year. So we know taxes are going to change. We've been hearing they're going to probably be reduced. I've also been hearing that they've been wanting to eliminate them. I don't know if that's going to happen or not. But I do know I see a trend where we're starting to see tariffs. Are they going to continue? I don't know. And sometimes tariffs does not mean that it's going to always affect you, even though inflation could affect some people, depending on if you buy those products or services that come from those countries that offer those products and services. If you're buying American-made products, you're probably not going to have nothing to worry about. Just food for thought. That's, again, my little opinion. When it comes to tariffs, if it's going to be inflation, we don't know. Even if it is, what are you doing from a cash flow perspective? If you had easy money coming in, you shouldn't be having to be concerned about inflation. Why? Because you're getting real income. And if your real income's coming from the where it's supposed to be going, inflation could affect the capital appreciation of those investments, but that's okay. I'm getting income. I'll wait it out. Why? Because I'm appropriately in a position to where I can get income plus growth. And it's going to be very hard to do that if you're focused on growth and very little income, or you're deficient of income altogether because maybe it's going out in a fee from whoever's managed your money. And so I got a commission report on to get in your hand, how to protect yourself from the dangers of inflation. And it goes into a lot of stuff that you want to know when it comes to, again, inflation is a problem. And of course, we got tariffs. I mean, people are at the end of the day, we don't know where things are going, but you fix problems ahead of time. Don't wait till they occur and then all of a sudden it's time to fix them, because sometimes it can come at a cost. What if, you start losing money or going down in value like it did in 2022? Then you have to wait it out again. And then at that time, you had maybe spend a year or two, you didn't get to spend them, any of your portfolio. If you had dividends, you could have. But this commission report can be yours if you call 888-930-1080. Again, that's 888-930-1080. and we will mail this to you or email it, whichever you prefer. 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks, and today we are talking about Live and Learn. And it's really just me really talking about the things that I have actually learned. But I also want to share it with you because I like the path I'm on. I like the advice that we're giving to people today. In our reviews, we do typically 3 to 4 client reviews a year. And the reason we do that is because we want to stay in front of people, because we don't know what people are thinking on a daily basis. And another thing too is I can show them and prove to them that they're getting their income from where it's coming from, and it gets them more relaxed. It almost gives them a permission to spend. Unfortunately, most people don't know how to do that, and so therefore they're spending money, not even realizing it's really coming from their principal. And sometimes their statements don't really move much, and they tell me, well, it looks like everything's so far so good. And I said that is until the markets have a downturn and you have no control of it. And then I guess the question is, what are you going to do? See, in my early 20s, the things that I lived and learned, and this is just me digressing. In my early 20s, I was real aggressive. I don't know about you all. I was very ambitious, and I've always been a very ambitious person. And when I see something, I just run at it and I take risks, and it doesn't work. That's fine. I just keep failing forward, so to speak. And, my dad always told me, he said, son, when you get about 25, 26, hopefully that'll stop that silliness, that boyhood that's coming out of you. And we've all been through it, right? And then sure enough, 25, 26 range, I started figuring things out. And, I started doing things a little bit more cautiously, not totally. I still had my aggressive nature, but I always make sure that things make sense to me. I study on it, research it, and so forth. I just don't think things so flippantly like I did in my early ages. And that's, again, kind of a live and learn moment. You see, when it even comes to finances, some of the things that I did stupidly, this is, I'm probably preaching to the choir here, because we're talking about, things like what Dave Ramsey talks about, getting out of debt and so forth. I wasn't really focusing on that. I was really more encouraged to buy that new smelling car. You probably have done this maybe too. I don't know. Maybe I'm just the only one. About every 2 years, I'd buy a car and trade it in. And I was doing it on leases. Well, you probably already know where I'm going with that, until I learned all I'm doing is going backwards doing that. So I quit doing that. Again, it don't take me long, but I'm glad that I went through it to some degree, and I wish I didn't go through it, but that's how we learn, right? I mean, we have to learn by actually doing what we shouldn't be doing and doing more what we should be doing. That's the reason why I like investing for income, because now I don't have to worry about where the income's going to come from, because it's real money. It's real money that's going to be made on a month-by-month basis, and I show that to people. And I don't know if you know this, but if you ever look, Fidelity does this. Some companies don't, some companies do, depending on where you have your money. But we use Fidelity. We use Charles Schwab. That's where our clients put their money with us at. And all we do is just manage our accounts and everything. Our online, they have full control. And what I do is I show them a statement. I turn around. I said, look at this statement right here. If it's one page, it kind of looks like it's just nothing but an income dividend type page. And what I try to point out to them is, we're right now in February, right? If you go from, it'll say February 2025, here's the paychecks that's going to be created for this month. And and March, it's the same way. April's the same way, all the way till January of next year. In other words, isn't that something that even Fidelity knows, or it doesn't matter where you have your money, but they all know that income is going to be paid to you because of what you own. That's kind of like me owning a rental property, isn't it? If I got a 12-month lease with a tenant, I know the next 12 months, I don't have to guess. They can maybe falter and not pay me, but it's more dependable, right? That way I can keep my home in that case, And I know over time it's going to go up in value. But what if real estate value goes down? Well, you see, you can invest in stocks the same way, live off the dividend, and know it's going to be coming in more than likely. It's a much more reliable component. It's not perfect, but it's a lot better. Just like rent's not perfect, the tenant's not perfect, but it's a lot better than it is the alternative, because you got to keep in mind it's kind of the necessary evil. You spend your principal, and very little income means you're digressing. You're going down in value over time to the point where there's no point of return, or you can just take the dividends, continue to live on the dividends. Even if you spend a little bit of principal, it's a lot better than what I've seen in people spending principal. And, that's the reason why we even do a retirement risk report, on the show, and offer it to the people that are listening, free consultation where, you're talking to me, and we actually deliver a retirement risk report. That way you can see, are you on the biggie side of the of income, or are you still, spending very little income and more principal? And it's a big eye opener. And, for the people that see this, they immediately they want to be able to do something. And so that, that's it's like an aha or an epiphany that goes off, or the light bulb goes off in their mind. So with that being said, if you want to learn more about income first methods, a realistic way to generate income in retirement, I got my book, Retirement Income Shift, How to Get the Most Mileage Out of Your Money. #1 bestseller, Amazon, for 3 months in a row. Personal finance still is. Since October, since its release. It's available for the first 5 callers of today's retirement income source. Call 888-930-1080. Again, that's 888-930-1080. We'll mail this out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. When we come back, we're going to be talking about how dividend stocks for the last 25 years, a dividend portfolio that was focused on dividend, how it almost doubled what the S&P did. Yeah, that's true. That's right. And these are real numbers, not hypothetical numbers. I'm going to kind of cover that. That's the reason why I'm so glad I'm in the dividend side of the equation in this industry. It makes me feel a lot comfortable. It makes my job a lot easier. So we will be back here just in a minute. Again, this is Retirement Income Source. This is Tim Sparks. You're tuned in to the Retirement Income Source. We appreciate you spending your hour with us here today. This is Tim Sparks, and our show is sponsored by Sparks Financial Group, a firm right here in the heart of the Bluegrass, Selection, Kentucky, also serving Louisville and Northern Kentucky and middle Kentucky as well, or Central Kentucky. Today, we're talking about live and learn. I don't know about you, but I have learned a lot over the years. Right now, my son, a good example, I told him, he even took a Dave Ramsey course. We want him to take this early on, and hopefully he would maybe learn a few things, because I like Ramsey's tactics about staying out of debt. Most people, especially young people, struggle in this category because, they step right, when they leave their home, they're so used to all those good years, living under mom and them's home, living with mom and dad, where they were taking care of them and maybe going out and not understand that mom and dad struggled to get to that point. And sometimes I think, that kids don't want to listen. I was the same way. But I learned a little bit earlier, and I'm hoping to get my son back there. But, he thought it was really cool to get in the debt. And a lot of that was just because he wasn't paying attention or thinking about how he was going to repay that. And not only that, I told him it's going to take 6 to 7 years, because now you've obligated yourself with these loans. Because, think about it, these car loans are too long today. I mean, and by the time you get to the 6 or 7 or 8 year of that loan, the car is probably already too old to the point where you may even have to turn it in. And so it didn't make sense to me. But anyway, so I think he's finally starting to see that. And he's right now just 22, so hopefully he'll get around that. But that's a live and learn. But when it comes to your money, another thing that I have lived and learned is what instruments it takes to be able to get through retirement. And for 14 years, I've been showing people the wrong way. And if you want to get through retirement, get the most mileage out of your money, then you invest for interest and dividends. That's income. And then you got to have the right vehicles to do that. And you can do that because they are totally available today, but most people don't have those available because they're even their financial advisor are oblivious to it. And they might be able to give you a good answer on what they are and stuff, but they are, there's a lot more work goes in. They're going to have to spend a lot to be able to have a analyst in there to be able to do something like that. They just don't want that to be part of their overall cost. It messes with their profits and stuff. And why? Because those people come at an expense. So people try to rely on cheaper, inexpensive research, and it comes at a cost. Because at the end of the day, think about it for a moment. If I can get $50,000 in real income and interest and dividends, that's a lot better than me only getting $10,000 or $15,000 and spending $30,000 or $40,000 each year of a client's principal. It don't even make sense to me, but that unfortunately is the way financial plan or retirement plan is being done today. So something that you have to remember when it comes to growth, when you're trying to grow your investments, is you got to understand that the markets do two things. They go up and also they go down. And most of the people who are listening to this show right now has been building wealth for a lot of years. We get a lot of people that are not really in retirement. We have some, we have a combination of both, but we have a lot of people that are still working, thinking about retirement. And, when you're accumulating wealth, the best years when you accumulated the most wealth, believe it or not, was between 2000 and 2013. Why? Because the market took a 50 and 60% hit. Well, the people that if they retired during that time, that was not a good thing. Why? The down market actually affected them. A lot of the people probably even went back to work. Probably was a Walmart greeter for all I know. But I'm going to get a commission report in your hand, the hard lessons of stock market history. This is going to show you historically that this is not the first time that happened. And if it does, what are you going to do? You just going to take it on the chin, or are you going to do something about it? Well, people don't realize what it costs whenever you lose that kind of money. Like 2008 financial crisis, it happened quickly. I mean, it happened over a 6-month period. What are you going to do? You just have to take it on the chin, I guess. But, what's your retirement plan? What's your income plan going to be if that happens? It's not if it's going to happen, it's when it's going to happen. And are you prepared for it? So that commission report, if you reach out, is 888-930-1080. Again, that's 888-930-1080. And again, it's a great commission report talking about stock market history. Speaking of stocks, and I'm going to talk more about this next week, we're going to be talking about why stocks that pay income versus stocks that don't pay income. Unfortunately, most people are utilizing stocks that pay very little income or no income. And the reason I say that is because I don't want to see every day when people come in and we do a retirement risk review, showing them exactly how much income they're getting from their current portfolio. Most portfolios got anywhere between 70, 80, or 90% in stocks, and hoping and praying that the markets or the wind will continue to be at their back. Well, you're not prepared for worst case scenario. You're really prepared for best case. That's a hope and a prayer portfolio. The best way to do that is to have dividend paying companies. And so I went back and I did the S&P 500 Dividend Aristocrats. This is an actual index that's been around since before 2000, but I went and looked at the actual total return. Total return is where you get income and growth, just like you get total return from the S&P 500. And I compared it to the S&P 500. Well, what's shocking, if between 2000 and 2013, people were underwater in the S&P 500, didn't make any money at all, which is not good news for anybody in retirement. Where if you were in the aristocrats, this is a dividend paying stocks, you would have made double the return. Now, just think about what I just said. These are actual data, calendar returns, no BS, and all that stuff. A lot of people likes to think you make up stuff and all that right there. I see it with my own eyes. That's the reason I do a lot of research. That's why I like dividend stocks. Why? Because first of all, typically they perform a lot better than growth does in down markets. No, nothing perfect. Again, they are stocks. And of course, past performance has nothing to do with future performance. But the good news is stock for stock, stocks are stocks. They're all duck, they quack. At the end of the day, I'm looking for some defense. I'm sure you are too. And this particular type of portfolio only generates about a 2+% dividend. Our clients are getting double that. I can imagine what would happen if we inserted double the dividend. But to me, that's profound. And we're going to talk more about that next week. With that being said, if you want to know more about income first methods, my book, The Retirement Income Shift, talks about that. How to have dividends plus growth, possibly, depending on the type of portfolio you want to design for your own comfort level. Or if you're conservative, doesn't really matter. You can get income either way. And if you want to know more about that, this book will be a great start for education for you. And if you want it, if you're one of the first 5 callers today, reach out 888-930-1080. Again, it's 888-930-1080. And we'll mail this book out to you again if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. We thank you for listening to the Retirement Income Source. Again, I can go for several hours about this topic, but we're going to continue this again next week. I hope for at the beginning of this show till now that you've learned something and benefited from this show, and look forward to talking to you and spreading more information about how to retire stress-free in retirement. Thank you for listening. Be safe out there and enjoy your week.